All right, so the highlight here, and you could actually see because we have hit a lot of major publications for this, Housing Wire and all of those, regarding this product. So
So
this product set,
this product is
it's a one-time close, new construction. All right,
okay.
I'm gonna do the commercial pitch right here. I'm gonna like go photogenic, everything.
Yeah.
Radio voice. Here we go. All right, so we have our one-time close, new construction product. We have three different products that
Hold
fall
on.
into the.
What does that mean? Explain to me in plain English, please.
Yep. One time close means that you come in as a borrower, you get into the new construction product. We start you from the beginning phase, which is the construction phase. You're going to have a little bit higher rate for the construction phase because that's whenever it's kind of like thinking a loan on the building phase. The builder gets paid out in phases throughout the building phase. And then 30 days to 60 days prior to the actual finish of the build and getting that occupancy cert and be able to move into that property, that's whenever we do that one-time roll down of the rate, and we roll it down to whatever the market rate is for that established product that we fit it into. And
So
so
basically, you're talking about takeout loan.
yeah, our new construction, just so you understand the way it works, because if you compare it against other products, you might start going, whoa, what is this about? So let me explain the construction rate and then get to the roll down rate. The construction rate roughly on these products, you're going to see a rate anywhere from an 8.5% to 9%. Now
Only.
this,
Only.
Is that based
yeah,
on
only.
is that
Think
based
of
on
it this way. Let's
Okay.
say I am lending you.
Jason, anyone has a question?
Yep, go for it.
is it based on prime?
No.
Okay. That's pretty expensive though, because I mean, the lenders that they deal with, they go at prime, and prime is at what, 6.75 now, even on spec.
Yeah,
but
so
the reality is ours is interest only throughout the entire period.
Oh yeah,
Yeah,
but then it's also interest only.
Yeah, so let me explain the construction rate because I warned you that just hang tight with me on the construction rate, right? So the construction rate's roughly going to be anywhere from 8.5 to 5 and to 9%, right? The reason why it's 8.5 to 9% because realize that you have three different products. So what I encourage you to do, and especially the DSCR and our non-QM one-time close new construction, which from what we understand is really the only players doing this nationwide. The conforming, okay, conforming is going to be more prevalent of a product out there and fitting into the conforming world. So the construction rate is going to be interest only. And let's say I'm just going to use a number, you need $1 million to do the construction. During that phase, you don't get the full $1 million right away. We hold it, and then whatever the builder needs, and during his phases and his draw periods, then he draws that $1 million out in bits and pieces, right?
How do you structure draws?
That's standard. I mean,
no, we structure draws up to 10 draws within the initial part, so we allow that. We structure the draws according to what the builder's plans are and what they plan in each phase and what the amounts are going to be. So that's kind of the pre-planning phase. Now, are we charging the 8.5 to 9% on the full $1 million? No, we only charge it on whenever the draws start coming out. So yes, payments will start going up, but by the time that you get to that end payment where the full money is pulling out, if the full money is needed to be pulled out, we're ready to roll down the rate into that end loan.
And Yvonne, how it works in your world?
Well, the same, exactly the same. I mean, you only pay interest as you draw, but the rate is much lower.
Yeah.
Yep.
And it is also interest only.
Yep.
Yeah.
So now it's something.
And does that compare? Let me ask that. Does that are they also able to do the DSCR setups or anything like that, or the non-QM bank statement for those construction deals?
No, because I mean, no, because well, if it's a spec deal, they don't look so much. They understand contractors. They understand the income fluctuates from one year to the other. So and basically they have relationships with those contractors typically.
But you're talking about spec
No.
deals.
Yeah,
Jason
yeah.
is
So I mean,
talking
obviously we
about-
don't focus on spec, and then the
Yeah,
other
forget
interim as
about
well
this.
is
It's not comparison.
So
I'm talking
let's
about
right, and we throw that non-QM aspect into it, and the other portion is too we don't use a third-party vendor as everybody else does to control their draws. We do those in home. Everybody else uses like Granite Bank, a couple others. We control that piece in house too, which completely streamlines the process.
So
Yeah.
basically, from what my understanding, it's different animal. So if what Anivon is describing, it's builders who build for specs.
Yeah, but
Here-
I've done unoccupied loans with that same bank, and typically the way it goes, I understand the client understands that it's a short term and that they would have to refinance at the end of that, at the end when they get in the notice of completion. But where was I going to go with that? Yeah, so when they look at the owner-occupied construction loan, they want to make sure that, I mean, they look at the financials, obviously, and they want to be sure that the borrower is going to qualify. So they basically ask me to make sure that the borrower qualifies. So they want me to give them a pre-approval letter, basically.
Yeah.
The takeout. And, you know, the clients that have done construction loan, owner-occupied construction loan for, they're not, I mean, they know, I mean, they're fine financially. They can afford the payment. Otherwise, I would tell them right away, I'm not going to be able to get you a construction loan because I can't get you the takeout.
Yeah. So what you're describing is typical situation where we start with takeout loan, not construction. Because this is how I work too when I have this construction loans. I have to qualify, be sure that, let's say, I assume interest rate in a year from now will be similar to what it is now or higher.
Yeah.
And then I have to qualify the conventional way. What Jason suggests, different animal. He says that it's not conventional. Not everyone is qualified. Let's say to qualify for $1 million loan, you need to have today 15,000 income or 20,000 a month. And if you are self-employed, like in the case of Elena, they cannot get this conventional takeout loan. So what this Jason says that we can do it just based on the SCR.
Yeah,
And
I
you can-
understand that. And that's great. That's a great option for.
Yeah, exactly. So let's not understand there is two different products, and we have place for both of them. If
Yeah.
client is well qualified, hallelujah, and others can also benefit from this. So
Yeah.
it expands our palette.
Great.